Now, Dave, and Dave's going to talk later today, I mean, he'll explain to you how two firms are pretty much tied, Deloitte and Arthur Andersen. And with Arthur Andersen, it's a young bunch of partners, and with Deloitte, it's senior partners that happen to know me, because I went to school with one of them. Now, if push comes to shove, I would bet a lot of money that the Deloitte guys are going to roll with us, only because Gary knows me from umpteen years. Although John Dolish, who's a senior partner at Arthur Andersen, who doesn't even know we're talking to Arthur Andersen. Okay, I mean, we're going to make it a dogfight now, because I went to school with both of these guys. It's going to be a dogfight. It's going to be a thing of beauty, because they both know who I am exactly. The gentleman in the back.
What would you do if a mobile home wanted to sell, but there were competing people wanting to buy, and you haven't got the money yet?
Well, normally if there's competing people, we're not interested, because somebody's going to offer more than we are, because we don't pay top dollar, if you can see our formula. So normally we're not interested. We don't compete. If this has never happened, but if we were the highest and they wanted to go with us, I mean, they have to play it our way. We have a 90-day, a 60-day review period of due diligence before we go to contract. Then we go to contract, we have another 30 days to close, so we have 90 days to close.
Plus, they're not going to walk away anyway. You know, if you're still putting the financing together at the 11th hour.
Larry. Yeah, he doesn't follow instructions that well, does he?
If you got a a $4 million asset, a $5 million asset, and you see a guy ready to close, and it's 90 days is the time limit, and you got to wait a couple extra weeks, you can bait them on or whatever. You're not going to just walk away. You're tasting the cash. So.
Finance guy, huh?
Yeah. Hey, okay. And the other thing is, we've already been told by the at least one of the owners that I met. And if you're on the way and you can't do it in the time limit, I'll give you time. And Tyler made a good point. And see, the key is we have no deposit. See, it's why I got into the real estate business after 25 years.
Plus, we only own the dirt.
That's right. We only own the dirt. I don't, we've got no read, no write, can't talk, one eye, only own the dirt. I mean, this is a thing of beauty. This bitch was hot. I could tell right away. It didn't take I didn't have to Lotus 1, 2, 3 this to death to figure it out. Now that I've looked at the numbers, and I still don't understand the whole deal, and I never want to understand the whole deal, but I know enough of it that it is a cash cow for us. We will put a lot of money in our little pocket, her little pockets, my big pockets. Okay, well, I want to finish the questioning up, and then we're going to take a break all the way back.
What's your exit strategy? Once you have 100 parks under your ownership, where do you plan to go from there?
Obviously, we want to go public is our first choice. Second choice is to sell it off to either a REIT or an insurance company.
A REIT is a real estate investment trust, a public entity, public vehicle. And the other thing that I like about consolidating fragmented industries, see, nobody's doing this. It's like taking an option public. Nobody's done this before. The biggest player in the country who's now given up is Sam Zell in Chicago. And he was buying 5-star parks, which is the creme de la creme, the Ritz-Carlton, at the highest part of the market. And nobody else is doing it, so nobody can tell us what the rules are. We're making the rules as we go. And we're basically going to bundle up 3 to 5 to 7 of them at a clip. And now we've given the potential investor a diversity of risk, because it's not all on one park. It's 3, 5, 7 parks. So, I mean, it's a good deal.
You're saying you're going to bundle them together. Are you going to purchase them one at a time, then refinance the whole thing, or are you going to just pay? No, we're going for 7.
No, we're going to bundle. We're going to finance them the 3 at a time. Now, we may refinance down the road when we get a whole bunch of them together. Okay, if there's no more questions, we're going to take a short break. Get up and rest, or rest, whatever you do at a break. Oh, okay, wait a minute. Okay. Is it too hot or too cold? Okay. Yeah, we can. Yeah. Huh? Okay, we got the air conditioner. Now we've heard from Lucinda Burke. Now we're going to go to the complete opposite end of the continuum. Well-educated, 25-year-old young woman had a good idea that I helped make a little better, and we're doing great. Okay. Now, a little bit of marketing experience, had been raised in the industry, but I mean, how much business acumen can you have at 25? You know? And she's making it work. Okay. Now, before we move on with the actual outline that you've already got about deals, making an acquisition, I want to bring up an example of somebody that has a much smaller universe of acquisitions to look at. Basically, with Lucinda, we can put offers through like shit through a goose. We just throw them out there. And some of you are in industries like that, okay? But some of you aren't. There's a finite market. Maybe it's 20, 50, 100, or even 500. It's still a lot less than when they're in the tens of thousands. Okay, Bruce. I'd like Bruce to come up. Bruce is the founder, president, CEO of Property Tax Consultant, Inc., and of which I'm the chairman and his partner. And he was successful in business before he met me. He attended one of the very first seminars in the summer of 1993 at the Meadowlands in New Jersey. And we had the misfortune of having the Grateful Dead playing right near us, and we had Deadheads. Those are the bums that follow the Grateful Dead around. And we had a Indian wedding, Middle Eastern kind of Indian wedding, and with all the screaming music. And this is when the seminars were 18, 20 hours long. And Bruce and I helped him change the way he did business. We've liquidated his old business, and we've started a new business here in the last year or so. And I want him to walk you through some of the problems, some of the successes, how we've changed, how things have changed. We have a finite amount of people that we're after. The businesses are not for sale. Go ahead, Bruce.
Well, Dan said the road is going to be bumpy, the prize will be worth it at the end, and that you'll learn to understand that litigation is a business tool. And all of those have come true. I first met Dan in a Jay Abraham seminar, and it's the same thing we've done since that time in putting together a dream team. As I listened to Jay Abraham, and he's certainly got a lot of good ideas, but when I looked at Dan and listened to him when he got up, he was infinitely more successful than where we were, and maybe more important, he had done that and been there, which was the test I used. So as I looked at the Jay Abrahams or any of the other number of people that are out there, they just didn't fit that test. And early on in business, I learned that you partner up with people that have done what you want to do, and you can use that track record, obviously. So that worked out well. He told us at that time to pare away most of the companies that we did business with. We had a lot of clients, but we had very few, although a lot of successes, Fortune 500. So we went back, essentially got rid of the clients that we had that were smaller clients, paid a lot more attention to Fortune 500 clients, and grew the company very well, added, I guess, 10, 12 Fortune 500 companies in a short period of time to that. And that worked well. But the thing I didn't see before meeting Dan was the real way to grow was through acquisition. And so I went back and said, that's obviously what we've got to do. About November of that year, we ran across, through a customer, and it turns out our client, it turns out that a lot of times you don't know where these deals are going to come from. They had looked at the largest company in the property tax industry. It was for sale. That's one of the reasons now we look for companies that aren't for sale. But I ended up calling the chairman of that company. We were in the 11th hour and essentially went on the track record we had, the track record of people. At that time was just Dan and I. And the intent was to get together with them to meet to talk about purchasing the company. To say that my partner was less than enthusiastic would be a big understatement. He had been involved in a good-sized acquisition once. He had come down to the point at which financing was needed. They were at the closing table. His partner turned out to be a con man that couldn't end up delivering the money. And from that point on, he stuck his head out once, he got burned, and he was never going to do it again. So he said, which is good to hear. He said, you can't do this, you can't do this, you can't do this. We ended up getting a meeting with the chairman of that company. We went out and met with the company. There were already offers in place, and they, as I said, they said you're coming in the 11th hour as far as that's concerned. But we were successful in selling him on the dream of what we wanted to do with that industry. He said there's no doubt you could triple the sales of this company. And we had some good talks towards putting together a deal. At the same time, there was a group out of New York that came in and made an offer that was probably 25% at least over what that company was worth. And Dan at that time said, that deal isn't going to go. What they're doing is they're tying up the deal. They're going to go out. They're going to shop the deal. And probably in 60 days, I think it turned out to be about 59 days, they came back.
Off a day.
Yeah. They came back and they said, we can't get the financing, the deal's done.
Let me say something. We were going to pay $27 million in non-recourse financing. Non-recourse means we are not liable for it. This is a good thing. Financing that you do not have to put your miserable hide on the line is a good thing. These SOBs offered $42 million. It was Morgan Stanley. And I've done business across the table from Morgan Stanley, one of the premier investment bankers in the world today. But I know that they go out, hook a deal in on their name, and then they shop it. And then it collapsed.
Yeah, and it did collapse. Now, the employees this whole time were trying to buy that company, and they just couldn't put it together. The owner of the company said that was really his first choice. And they were smart enough during the time that this was going on that they did raise the capital needed, and they closed that deal. So that transaction ended. Sure. Sure. They went out, and during the time that Morgan Stanley had the deal, they did raise the capital to end up doing the deal. That's what the principal wanted to do originally, to sell it to his employees, so they made that happen. But what came out of that, and again, I mean, you spend so much time in some of these things that if you begin to look, well, even if the deal doesn't go, what can we get out of it, is that we formed a real close relationship with the chairman of that company, who then left, obviously, when he sold the company. And he took an interest in us. He had no question that we put together the right people to do what we were doing. And he said, I will help. He said, I've got a confidentiality problem that I can't give direct advice and input, which we respected. But he could give us some reads on companies that we should go after. So we then went after the second largest, and you'll hear this all the time. This was not a company that was for sale. Called him up. I used his name to give some credibility, as well as some of the clients we had obviously worked with. And he said, company's not for sale. We're doing great. We've never done better. When do you want to meet? And consistently, that happens. Now, he was scared, I guess is a good word, of, and this is, I think, what everybody sees at the end of the day, is can these people perform financially? And so he asked for financials. We said no. We had, in the process of ending, which is still going on, ending the relationship with the first partner, we had gotten good representation for that litigation through O'Melveny & Myers. So we said, call O'Melveny & Myers, find out who these people are. We had, by that point, put together a good dream team board of directors, which had name recognition. And he made a call to O'Melveny & Myers. He felt more comfortable. And it shows you some of the value in working with a big firm. One of his relatives, and it went through a couple of chains, knew the vice president or the head of the real estate law division at O'Melveny & Myers. And he just said to him, are these guys okay? He said, yes. And so we ended up meeting. And we met down in Dallas.
And when a senior partner of O'Melveny & Myers or Coopers & Lybrand or Arthur Anderson says they can perform, the due diligence process stops. Whereas if you say you can perform, they're trying to find out the last time you had sex. It just stops dead. That's it. Why do you need a dream team? I mean, if there's no other reason, forget everything else. It gets you in the door. When you say your law firm is Warren Christopher's, the Secretary of State's law firm, it stops. If you say Henry Kissinger is your partner, it stops. And in many cases, although I'm not as well known as those guys, when they see my profile and they see it stops. The dream team is critical. Go ahead, Bruce.
And part of that dream team came from current clients. It was Walt Burdick, who was a senior VP of human resources. He'd been at IBM and worked for 5 out of the 6 chairmans. We asked him, and it's funny, I mean, a lot of people, good people, come out of retired ranks of executives. He said, if I can contribute, then I want to be involved. And what I thought was important, and Dan certainly pointed this out, is when you bring that dream team and those people in front of your prospects, most of them realize that if this person's retired, he's already had a successful career, he's not going to partner up with some people that are going to taint that in any way. And so, again, you get a lot of credibility, obviously, out of that. So we met with them in Dallas. It was a treat to watch. I mean, they were much, much larger than we were. And by the end of it, they were sitting there saying, we want to be part of this. Why are you interested in a small company like ours when you have these kind of plans? And they were caught up in the middle of it. We then began to do, and to make a long story short, we began to do our due diligence, and we got the financials from them and signed confidentiality agreements. And one of the things Dan talks about is you need to get out in the next upcycle. These guys didn't know that and didn't pay attention to it. So 3 years ago, their business was probably worth at least twice what it was today. And they had put together a plan whereby it was going to be much, much better in the future, and they wanted us to either buy on what it did or what it was going to do. And we said, obviously, that can't happen. So we made an offer. It was rejected. And it was insulting, basically. Yeah, it was very insulting. But we still maintained a good relationship at the end of it. I didn't want to pull out, and again, I mean, it's a good lesson, but I didn't want to pull out of that. And again, it comes back to realizing, when you cut your losses and just move on to the next one, because there's plenty of deals out there. And we did that. We then ended up with another company that we looked at, which was smaller. Went through that process again, same process. That the company was not for sale. We met with them, and again, I mean, as part of the bumpy road, we learned a good lesson there. Is that in the meeting that we had, certainly the people that were there saw where we were going and felt comfortable with that. But not all the board of directors was at that meeting. And when they went back and talked to the group, our vision of where this company could go was so far outside of their comfort zone that they just got nervous. And they said, some interesting things which stops a lot of people in success. They said, we may never cash in, which is true, but we're comfortable with where we are. We don't want to give up control, and we're happy being independent. And they just wanted to be a small company along the way. I guess after that last occurrence, I said that there's a smarter way to do it than putting one after another, and particularly where you're got a smaller universe. So now we've contacted, again, 4 companies that aren't for sale. All 4 of those companies returned the calls, and 3 of those companies have interest in talking, and we're in the process now of just setting up those meetings. But I think a lot of it certainly was the dream team, without any question. And once they got the board of directors, the way they responded on the other end of the phone was, and many of them said it, that there's no question financially and managerial that you can do this.
Can you explain that instead of using the letter method to get, because in your packet there's a letter that you send out to get an appointment with somebody to buy their company, and Bruce has developed another method. Why don't you
the letter is the second part, really. Is the first thing I do is call and ask for the principal. Usually what I do is, not usually, I do ask for that person and leave a reference that this person in the industry that's well known, that we met from the first acquisition, suggested that they were a top-notch company and one that I should talk to regarding property taxes. They call back exclusively and very quickly usually, and then after that it's a quick conversation. We just say, this is what we've done, this is who we've represented, this is who's on the board of directors, quickly, and send them a letter essentially stating that, attached to the biographies, and then we move forward from there. But I found going after companies that weren't for sale an awful lot easier, and it's 100%. I mean, there's nobody that we've contacted that has said, oh, we won't meet with you.
Another interesting point, he alluded to it in his opening remarks. His partner that didn't want to grow the company, and we liquidated that company we're in litigation with. And you've heard me say I'm 225-0. I've been involved in I've just recently settled 2 big lawsuits favorably where they paid me a lot of money. And but litigation is a business tool. And whereas because of naivete and because Bruce hasn't been through as much scar tissue producing activities as I have, he thought that this was going to be over in a month or 2. We are now in the 16th or 15th month of the fight. And it has slowed our acquisition program down. To say when you're in a, it's not life and death for us because we have all the money. It's life and death for the other side because they don't have all the money. And but it's it slows you down. And for those of you that are cherubs, unless you get mentally attuned to it, if you're not used to fighting life and death legal battles, it will make your rectum pucker up big time. Big time. You'll start breathing through your rectum. When I'm scared, I know it's because I'm breathing through my rectum. That's my valve, so to speak. That's when I know I'm scared. And you've got to get used to it, and you've got to surround yourself. Part of that dream team has got to be lawsuit aware. They've got to be able to know that you can fight through a legal battle and survive. If you don't have anybody in your company and you don't have anybody on your board of directors, because your lawyers will represent you as long as you can pay. Basically, then they'll drop you like a hot turd. You've got to understand that. Part of being, Bill Gates and all these guys have been through thousands of lawsuits between all of them. You got to understand that. It's part of the exponential growth. It's part of it. If you can't, if you're not willing to do that, if your pay price to action is you're just going to walk away from all these deals, then you're not going to grow exponentially. You're just not. Litigation is nothing more than a business tool. And the thing that I hear when I go to the CEO clubs, all of Mancuso's deals, the biggest thing they bitch about is the lawyer's fees. And these are little moochy pennies. They have pennies. The reason they have pennies is because they don't fight in court. You better get your mind made up to it. Whether you're in Europe or here, it's fight or die.
And what Dan said was also true, is that, and I've remembered what he said, and we're going to drive it down his throat a bunch of times, is that the attorneys at O'Melveny said, we can finance 100% of the deals that you'll look at. If you want to do that, we've got clients that will invest in those all day long. And that, again, is the reason you deal with those type of people. If you're dealing with the attorney on the street, they're just not going to have those type of contacts. So, as Dan said before, you just keep pushing. You look at it, you know if it's going to work, you know if it's not. At the point it's not going to work, you move on to the next one. And it is absolutely a numbers game.
Yeah, and Bruce has become more aware of that in recent weeks, basically. And he went to the Castle seminar in January. And it's a numbers game. And I said earlier today, if you are empowered with nothing more from this 12-hour experience, then it's a numbers game, growing. You're gonna eat your competition up alive. Now, later on today, I'm going to have one of the Mosbys. Have you drawn the short straw yet? Oh. No wonder he's looking happy over there. Okay, and because they're in a startup that is an invention kind of thing, a patent thing, and there's the basics still hold, but there's even another set of parameters when you're starting something up that's what I call an artsy-fartsy, mad scientist deal, and we're going to talk about that later on this afternoon. Okay, Bruce, any questions of Bruce? Yeah. Explain to them the business we're in.
Yeah, the business is, what we do is we look at property taxes of businesses. We decide, obviously, if they're too large or too small. If they're too large, then we go in and challenge and reduce them, and we split usually half the savings.
We don't get paid unless we find.
Yeah, so it's high risk, high reward.
Yeah, and IBM and AT&T are two of our clients.
Yeah. IBM, AT&T, Kodak. IBM, we walk through all of their properties. Pretty much in New York up to their corporate headquarters.
What do you mean by liquidating?
Oh, this is the previous business.
Yeah. This is I really had to make a choice. We were in partnership 50-50. He had no interest in going forward with acquisitions, and in fact was a thorn in the side of that completely. So the choice was you either give up on that side of things, or you end that company, split up the clients, essentially split up the revenues, and that's where the fight began. I thought 50-50 was fair, and he didn't think 50-50 was fair.
Now he's got nothing, basically,
Yeah.
the other guy.
Yeah.
Because you always say, let me say something. This is important. For those of you that are in business with me, you already know this. There's the high road to doing a deal, and there's the low road. You always start the high road. I always start assuming that the other side's going to be a gentleman. He's moral. He's going to be morally right, ethically right, and he's going to deal with me in an honest manner. And almost always, it never happens that way. It's like these people that say that you can have an honorable divorce. I've never seen any of those myself, and I have plenty of friends that have been divorced. I mean, you start on the high road, but when they take the first step onto the low road, then we shift gears, and nobody knows how to low road better than I do. I was raised in the gutter. I am a street smart guy that has a lot of money. But we always start. And a year and some months ago, I told him early on, I said, don't be surprised when this guy commits suicide. Remember? And at that time, that was the most abhorring thing that he could think of. Now, based on some of the things that the prick has done to us, now it's not such a bad idea. I mean, and he was institutionalized.
Yeah.
He had a nervous breakdown, and I still think he's going to blow his brains out and save us a lot of trouble here. But you always take the high road, ladies and gentlemen. I mean, you screw with the kind of names that I've talked about, the Ross Perot's of this world. I mean, these guys know how to take the low road big time. So you better be ready to fight. I mean, so when you jerk somebody, one of these guys you're trying to do business with around, I don't send you a nasty letter. You get a lawsuit from me. I file against your wife, who's 5 months pregnant, at 3 o'clock in the morning. So, I mean, remember that. I mean, there's a reason why there's not a bunch of people up here. There is. Okay.
Yeah. And the last thing, and it just goes back to the first acquisition that didn't work out, is that CEO that's now left the company, 3 weeks ago, we've stayed in contact, came back and said, if you find some deals, there's no question with what you put together that it's going to work out. Keep me in mind as long as it's not in property tax. Keep me in mind, I've got plenty of equity and plenty of capital. And so you never know where these things come from.
So this is the guy we tried to buy. He wound up selling to his employees. He walked away with, I don't know, $10, $20, $30 million in cash. And now he wants us to keep him in mind as being an equity player in one of our deals because he's impressed with the system that we've had. But I remember early on when he was gone over the holidays and we were working on this acquisition and it fell through. I mean, your families, first time you guys missed Christmas, will not look upon you favorably. And I'm being kind. Your wife or husband, significant other, and no, you only hurt the ones you love, will look at you like you're dog dung. They just will. Okay, thanks a lot. Now, question from Jeff.
And I'd just like to know some of your methods of encouraging business companies that aren't for sale to sell.
Okay. Well, I said earlier, if anybody that has debt, you hold that, otherwise it'll reverberate, has debt, you can go to the bank and buy their notes away from the bank. If you don't think so, you just tell me where your bank is, and I'll give them a call. Let's, for example, I said this during the break. He owes the bank $300,000. He's got a $300,000 line of credit. He's drawn $30,000. He's drawn $260,000 down. I go to the bank and I'll say, I'll give you $270,000 for his note. The bank will say, where do you want us to sign? That's how quick it'll be. Okay, now, all notes, all loans have a clause that basically the financial institution can call the loan whenever they feel uncomfortable. So now you have that ability to do as the guy. And so you tell the guy, I think we ought to talk. Oh, okay. I think we ought to talk. Okay. Or another way of doing it is I go to all his suppliers. I buy his suppliers. I buy his customers. And now I represent 40% of his business. And we ought to talk. Well, I'm not for sale. I said, well, I've got 40% of your business here. I think we want to talk. This is how Sears and Walmart got big. Sears and Roebuck, that's how they went out. They got to be 20, 40, 50, 60% of your business. And old man Sears would then say, we're in business together. That's how Sears got into so many businesses. There are other ways, and I mean, no, and these. The first thing you do is you go to the company and you ask them. But I mean, the easiest way is the way that he's doing it. He's calling them up and they're saying, we're not for sale, but when can we meet? And again, you don't change your financial parameters any, but a lot of you I hear cry, oh, I'm in an industry, but nobody's for sale. One of the questions I was asked about nonprofit organizations at the break or sometime in the last hour or two, well, how do you buy entities, units, companies from nonprofits? There it's an educational process. You got to educate them. If the nonprofit thinks that they will benefit somehow, you can make the nonprofit part of the upside. The way I'm going to run the business is going to be significantly better than the way you run the business. And I'm going to let you be part of the upside. So you're going to have an ongoing cash flow stream, not even be bothered with the hassle of running it. Plus, it's a pain in the butt to you now anyway. And you explain to them, it's a pain in the butt. It's not making any money. It costs, you have to service the entity by putting money into it. And now you get rid of it. You let me run it, and I'm an established person in the business. I have this dream team, this track record, going back umpteen years, and I'm going to give you 10% or 5% or 12% or whatever of the upstream. Nonprofits want to make money. So, but I hear all the time that nobody's for sale in my industry. Well, that's baloney. I mean, at least half the acquisitions I made weren't for sale. Did I answer your question? Okay. Jim Bullard.
Are banks required to notify those people that somebody's shopping their note and give them recourse?
Okay. Depends on the It depends on the legal document. It depends how it was set up. It depends on what state, because the state if it's an intra or inter-banking relationship, the loan documents, I like to have my lawyers write. Remember I told you, he who writes the documents first wins. And all you cheap SOBs, you want the other side to write the documents because you want to save the few pennies that you don't have to pay your lawyer. Whoever writes the documents first wins. I don't care how many times you change it. The reason I want my banking documents written by my lawyers is to make sure they don't have that clause in it. Because I don't want somebody coming and squeezing me. But I hear constantly, oh, you write the documents. So you can save whatever the pennies are.
Well, the bank has standard documents anyway.
Yeah, well, I don't sign any of those anyway. I mean, I don't care what the bank's got.
So
you're not required to use their documents. I have my lawyers redo the documents. Well, this is our standard form. Here with your standard form. We'll go to another bank. Oh, wait, Jesus, no. We can change that. And then when you come in with a powerhouse law firm, instead of your brother-in-law who makes $48,000 a year and only went back to law school when he was 51 because he couldn't get a job as an engineer. And that, I mean, I'm not exaggerating when I say that kind of stuff. Lawyers can be your finest business tool if you use them right. And the operative word is use. In Scotland, in England, in Wales, I don't care where. Is there a mic back there? Would you hand? Larry.
Bruce, you said that you're looking for all these companies for acquisitions, and my question is, why do you want to buy them? Are you buying them for cash flow? Are you buying them because there's upward potential? Are you buying them for the people that they've got? What are the reasons?
Well, the same thing that was really on the first slide Dan put up is that what we're in is a pretty fragmented business as well. There's regional companies that do this. There's other types of auditing that nobody's put together, and that's the reason. So we went after the biggest. We want to put those together either nationally or internationally, because there's international business as well, and then add additional auditing areas as well, and then take that whole entity public. Yeah. Yeah.
Now, to show you that I know we're on the right track and we were the leader in it, some of the big six are starting to do the very same thing that we've been doing. It's good and bad. It bothers me a little because they pay over the top because they're stupid. Yes.
If you're going for a deal, if you set up an appointment like in Bruce's case, he set up an appointment with those people, and let's say they are your competitors, and you go there, and let's say they don't want to sell, but then you convince them they want to sell. What kind of approach do you use if they agree to sell? They usually have a question: how much you willing to pay? Do you have the money? And what are you looking at? Give me an idea, because I've experienced that.
Sure. I mean, it's okay.
Give me an idea.
What are you willing to pay? Well, how can we tell you that until we look at the numbers? Well, what area? I said, well, anywhere from 3 to 8 times earnings. You tell me. I mean, I got to look at the numbers. Well, do you have the ability to finance? Yeah, here's O'Melveny and Myers. Call them. Call Coopers and Lybrand Corporate Finance that raises money. Call them. Here, you want to talk to 2 or 3 of our board of directors? Call Mr. Pena. Call Mr. Burdick. Call Governor Hugh Carey. I mean, it stops the questions. Bam, bam, bam. What is it? This guy's a $64,000 question guy here.
That's right.
Okay, go ahead.
The second part of the question: let's say if they agree to that, and they say, well, we're not making any money. We're doing $10 million in business, but we're not making any money. Are you willing to pay for that?
Yeah, a lot less.
I've experienced that.
Are you sure I'm willing to buy your miserable little company, but for a lot less? Oh, the reason we're not making money is because we don't want to pay taxes. Here, that's what I got for you, because everybody says that, which is crap. Then there's ways of looking at the numbers to tell yourself, not you, your financial person, to tell the Jose in your deal. Jose can tell you if you could have made money. We looked at a deal recently. He says 5 years financials or 4 years financials. The most he made in any one year was $71,000 or something. And the least he made $50,000. And 1 year he only made $20,000. And the company never made any money. Now, if he didn't make any money and the company didn't make any money, chances are the deal is not making any money. Oh, and so we make him give him tax returns. First, he didn't have tax returns. They got burned up in a fire. Okay? But his business really did burn down. It really did burn down. But then, when we said we were going to walk away, all of a sudden he produced his tax return. And they faxed 240 pages to his office in Florida. And, of course, our other partner wanted to know the answer to this in 14 seconds. You do not review 240 pages of tax return. And so I'm on the phone with the guy. This is getting off the subject. But I said, look at line 30 or 31 or 32. Whatever the bottom line is on your personal taxes. And what does it say there? It says 0. Oh, it showed losses. Okay, lied to me. Okay, and so there's ways. And so, but I mean, that's crap. You say, okay, if they can prove, or you can prove to yourself, or your dream team can prove to themselves that the company was capable of making money, but for whatever reason they didn't, that's one thing. But then you're buying it. Companies that don't make money, that's why I tell you, you run your company like you're going to go public. People that delude themselves into thinking that they're doing good by not paying taxes are morons. Unless you're going to keep the company forever and your exit strategy is dropping dead, falling into your lunch, then that's all right. And then you get what you deserve. But if you're operating on the QLA methodology, that you're going to have an exit strategy and sell to some moron, then you got to pay taxes. But you've been told all your life, put your money back in your own business and don't pay taxes. God almighty. And you wonder why you're all poor. I mean, it's a great disservice to Americans in business, Europeans, anybody in business. I mean, even Haitians in business. I don't give a damn. I mean, it just is. Unless you're going to keep the business, you're going to pass it on to your moron kids or your moron grandkids. Most of you aren't in that position. Because I'm in business to sell it to somebody quick. Microphone here. Oh, you've got it. I'm sorry.
Yeah. I have a question about, because I'm interviewing law firms right now. So if I shouldn't worry about having to pay the attorneys to be the people who write up the first contract, even for the financial institutes, because the attorneys are working for me for free because they're part of my deal, right?
Correct.
Well, I'm confused. Okay.
Correct. That is absolutely correct. If you do it right. Now, some of you have already got on the wrong foot with your lawyers and accountants. My advice to you is just switch. Because if you've been doing it 1 year or 20 years this way, to drag them back this way is going to be tough. Now, somebody like me can probably get them back. But I mean, it's going to be tough. I mean, they're going to have no incentive to switch. You'll threaten to leave them to go somebody else, they won't believe you. They have you. Switch. There's nobody in this room, well, maybe there's a couple people in this room that have the finesse to get a 20-year relationship or a 5-year relationship back the other way. But that's tough, especially when you can walk in and say, I'm doing business with Arthur Andersen for 20 years, to Coopers and all the other big five. This is the kind of money I've paid out. And then you beat them up and you pick one. Then you go back to Arthur Andersen and say, listen, this is the engagement letter from Deloitte Touche. Show it to him. I was going to say match it. Beat it by 10% or I'm gone. Financial services and accounting and the lawyer business is a dog-eat-dog business now. I mean, they give you their virgin daughter. I used to use Ernst & Young to come in every 3 or 4 years to do a bid on our auditing and our corporate finance work, just to keep Coopers & Lybrand straight. And then the first time I went, I did it. The partner in charge of our deal cut my audit fee from $500,000 to $250,000 immediately. And I used to do that every 3 to 5 years, and they'd say, "Oh, Pena's at it again," because they edge up your fees because of inflation and all this baloney. And then when they come in and cut it at 50%, the first whack, you know I was overpaying. Okay, let's move on. Now, how do you do an acquisition search program? And this one is for SDI, because I might as well get something out of it, because I got the CEO of SDI, my partner, sitting in the audience.
That's the guy you didn't want to hire, and you created that.
Yeah, I know, that's right. I didn't like him, I liked his ideas. These are real-life deals. I mean, I'm not making this stuff up. This is not an intellectual or academic exercise. Okay, the first key step to develop a synergistic, I wouldn't use a word like that, acquisition strategy that will allow SDI, that's Success Development International, Sean Casey, raise your hand, who's the CEO back there, to achieve the following goals. 1, to take SDI public. We are not going to find somebody stupid enough to buy SDI from us, so we're going to have to sell it to the public. Okay, we just won't. That is going to be. I said this a lot of months ago. Just that's not going to happen. Even an insurance company is not dumb enough to buy it, but the public is. 2, increase earnings per share, which means earnings per share means we are going to have after-tax income. Add value through acquiring companies that will, 1, add to the attractiveness of the SDI story. Help redefine SDI's identity, because we're got an albatross of so to speak, because part of our management team has a less than spectacular history, shall we say. That's why he didn't come. Yeah. 2, increase earnings. 3, increase size. And 4, vertical and horizontal integration. You don't even need to know what vertical and horizontal integration. They like to hear those words. Okay. Once an acquisition strategy to achieve the above goals has been established, a 3-pronged acquisition search program will be implemented as follows. People are writing this down, right? Okay, well then I won't. No, you haven't. You have it written. It's in your packet. That's in your packet. That's right. See, before I didn't give you anything, and then now we even write the shit down for you. But there's no 800 number on this. Huh? Exactly. Very good, Sean. Yeah. And we're going to double it again. Guess what? Okay. Implement it as follows. Now, all of you should have something like this for your own entity. Doesn't have to read like this, but in your mind. Because all of us that are in business with me and all of you that are just in here should start acting like you're going to go public. Now, some of you are in industries we will find somebody stupid enough to buy us. In SDI's case, we're not. So we got to take it public. And given the alternatives of taking it public or selling in the private market, always take it public. Because the premiums you'll get because of the liquidity. Always. I've never seen a company in the public arena that has sold for less earnings per share than a private company. Never. Never. Okay. Now, deals and acquisitions. And you also have this written down. You don't even have to write this down. Now, Lorraine, you may have to go around and show the person to fold it back so we have to actually show it to them because they won't be able to find it now. Somebody's going to raise their hand and say, I don't have that, Dan. Maybe now because I've embarrassed you, you won't do that. I don't have it, Dan. Okay. Why acquisitions are so important at quantum leap advantage methodology. Because I do not know any other way to grow exponentially except by acquisition. If somebody would have figured it out, it would have been me or some of the big names that I've used already. There is no other way. How to find targets within your industry through databases. Use your accountants, lawyers, bankers, current customers, and clients. The reason I've used O'Melveny and Cooper's and those kinds of companies or those kinds of firms over the years is because I've already told you. I have entree to Australia, Hong Kong. When I was thinking about taking one of my companies public on the Beijing Stock Exchange, I called Richards Butler, my lawyers in London, who put me in touch with their partner in Asia. And he said, there have been 9 public offerings on the Beijing Exchange, Mr. Pena, and we have done 4 of them. When I needed to be in business in virtually Australia, any place, I either talked to my lawyers or my accountants, and they put me in touch. Okay. How to get an introduction to a prospect. This should be preferably through a third party. Again, accountants, attorneys, bankers. Most of you have never used your banking for referrals. When we go through the interviewing process, one of the questions we ask is we ask the banker for 3 satisfied customers that they have banked so we can talk to them so they can prove themselves to be worthy to be our bank. Needless to say, they are not going to give you 3 dissatisfied customers. And then, for those of you that are still moronic enough to think you need a business plan, then we ask those 3 satisfied customers to give us their business plan, which they do. And then we just copy their business plan if you can't live without doing a business plan. And you plug in your numbers. Oh, the banks won't give me 3 referrals. You want to bet? The banks really aren't supposed to. They have to go and ask the customer. They're supposed to call the customer and ask permission. Because they just start willy-nilly. There's banking laws about that. But they do. I mean, Lucinda can attest to that. I mean, in Hayes, Kansas, of all places. Okay. How to make the best first impression through a quality board. We've talked about that. Legal representation, accounting representation, establishing a prior track record of transactions through a selection of joint venture partners. I've already said that the way you get a track record is to partner up with you, who's got 20 years of track records. The Taylors, Rodney and Danny, have gotten instant credibility, and it wasn't easy giving them instant credibility, by me being their partner. When I was early in my career, many of you have already heard, when I partnered up with Lejet, which was a multi-billion-dollar organization, and we used to have jet planes that you stood up in like a man. Not the jet planes you got to walk like this. We had a fleet of jet planes. Oh, will I take the Falcon today? No, I think I'll take the Instant. Nobody remembers that Lejet was my special limited partner. Special limited means no liability on their part. All they remember is they were my partner. We've already talked about how to structure professional fees. Is there any question on structuring professional fees? Because this is important. Bless you. Now, if anybody had a question, nobody raised their hand probably. How does this... Okay, give him the mic. Give him the mic.
Someone has to ask the questions around here.
You're Armenian, right?
Yes, I'm
See,
Armenian.
Armenians don't feel the pain. Go ahead.
All right. My question is, based on the success fee, we talked with the accounting firm and the attorney fee. What would be the percentage you would pay them, because it's a fee that you're paying them, one-time fee after the deal is done, after 6 months or whatever?
It varies, but these are the kinds of ballpark figures that I work with. Okay. Normally, I want to pay the accountants and the lawyers equivalent to the paralegal, their administrative costs up front. And that's normally somewhere, depending where you're in business, $50 to $100 an hour. If you're in a little podunk town that the top lawyer only gets $150 an hour, then it's $20 to $30, $40 an hour. So it's $50, $60, $75, maybe $100 an hour. At O'Melveny and Myers, just to get the wheels cranked up, I mean, the basic costs are $100 an hour, because the partners get between $250 and $600 an hour. It will be difficult, not impossible, for them to eat all the costs. Deloitte Touche, or is it Deloitte Touche said they'll push it out 5 or 6 months, even past our first acquisition, because they like the deal. Now, this will vary depending on how hot they are for your deal. And how hot they are for your deal will depend on how strong you sell it. Now, somebody, I forget where it was, one of the presentations I made recently, they said, you've obviously sold this way before. I forget who I was with. And I said, yeah, you're right, I have. And they understood, sold. So if you're enthusiastic and you're passionate, they will automatically buy off on your deal. So $75 for a lawyer, an accountant, depending on where you are again, it's minimal. Some of them will just absorb the whole cost. If it's like one of the lawyers that Lucinda and I are using in Phoenix, they said, we don't have cash flow problems. As soon as I heard that, it was a sexual experience. I said, Christ, this is wonderful. You don't want to be telling me that if you're a lawyer or an accountant. Not me. Because we will ride them like a bank now. I pay Coopers and Lybrand a couple times a year, whether I needed to or not. I wrote them like a bank. Same with the big law firms. Same with the big law firms. Now, when the deal comes to fruition, and this is where the Armenian's going to have trouble, because Armenian are kind of like being Scottish. They're a little tight. Is then you got to pay them a premium. I paid as much as 250% over their billable hours. You can get away with 125 to 150%. I see he grimaced when I said that. He grimaced, okay? But then you actually have to do it. You can't just bullshit them and tell them you're going to do it and then not do it. Because there's only 6 accounting firms you can go through before everybody in the country knows you. There's a lot more lawyers, but there's only 6 accounting firms. And Lorraine, can you turn up turn the air conditioning? I forgot to tell you that. Make it colder. Yeah. I mean, and rumors like that travel fast, because you won't get to the second accounting firm to stiff them before everybody in the world knows you. Okay. How to contact prospects, short telephone call, that's what Bruce was talking about. Letter regarding the board of directors, Lucinda talked about that, how she sends out the profiles, etc. I'm not sure anybody's ever read Lucinda's profile if they get past mine. And Bruce's, I'm positive nobody's ever read Bruce's, because we've got 3 or 4 very strong people on that board. Do we have a question?
Ballpark, what range would you have to be as far as annual sales of a company considered going public?
Well, for those of you that are a startup, I mean, you're going to talk about and act like you're going to go public. But I mean, now, I mean, you basically, if you do, I see little companies going public on regional exchanges that are doing $2, $3, $4, $5 million a year in revenue. Nothing. Yeah, I mean, before this bull market really got hot, I mean, I'd say $50 to $100 in revenue. I mean, you've got a guy in the CEO club here in town that's going public in the next several weeks that does, yeah, I forget what the hell, what is he? Yeah, Orange, Ben, I forget, what, is he $30 million or 50? What? Yeah. I mean, not too much in revenue. I mean, the market's hot now. Before the bull market's over, you're going to be able to take a push cart. 2 guys in a push cart will be going public. Yes. Okay. How to get the team prepared. What needs to be handled, covered, agreed to before starting into the acquisition game. Eliminate internal conflicts. Ensure congruent messages sent, fueling the fire. Everybody on your dream team's got to be marching to the same drummer. If you've got one that's not, get rid of him or her. If JC's brother would give us a problem, he would be jettisoned so fast it would make his PhD swirl over his head. You've got to have everybody on the same game board. I mean, because you've heard me say the most contagious thing isn't a positive attitude. The most contagious thing is a negative attitude. And you don't want any of those as part of your team. You want positive attitude. And you have to stay pumped up 100% of the time. You can never let down, and you've heard me say this, you can never share a doubt. The quickest way to kill an acquisition is to share a doubt with your colleagues. I told my wife the other night, we were talking about something, and she had overheard a conference call that I had on the speakerphone in my office. And she said, well, that guy didn't sound too positive. And I said, no, he wasn't. And he says, what do you think? I says, my doubts are bigger than his, but I'm going to have to make him think that his doubts are inconsequential. And I said, for 19 months of my life, as some of you know, I was involved in a life-death battle with a company that I founded over a lot of money. My assets were frozen by constructive trust. The judge, moron that she was, decided that there may be some legitimacy that Dan stole $140+ million. So she decided to play it safe. She just put a constructive trust on virtually all my assets. Now, when you got an overhead as big as mine, my personal overhead's bigger than any company in this room. My personal overhead. And you can't write a check. You have no access to your money. You don't know what getting squeezed is all about for 19 months. I mean, that's financial pressure. I never once told my wife that our money, and I'm mentioning it right now because Linda's not here, is she? I'm mentioning it right now. She still doesn't know. Most of you mealy-mouths would have to share it with your significant other. And you wonder why you got problems at home, meatheads. And you wonder. You don't share doubts. So your dream team, you don't be sharing doubts. This is the greatest thing since apple pie, motherhood, and Sears and Roebuck. It will change the way we have life on the planet. It will change the universe as we know it today. It will close the black hole in space. And that's how you talk about it. And all the deals I'm involved in, I may have some doubts, but I sure as hell never share them. How to set up and conduct the first meeting, and how to give the prospect a comfort that you really have the financial wherewithal, how to sell our dream and get the prospect enthusiastic about selling and walking away, or selling and staying part of the dream. Let the prospect choose the deal. The greatest way I like to buy companies is we got all cash, all stock, cash and stock. You pick the poison. And then we got some smart ones, MBA engineer, and he'll tweak the numbers. Oh, can I have a little bit of this, a little bit of that? Sure, whatever you want. You pick the poison. Okay. How to proceed to reviewing the financials, the confidentiality agreements. I mean, we talked about that. Now, creating the deal flow. Now, this is important. You create the deal flow in several ways, one of which is your fellow board of directors. I automatically increase the deal flow wherever I go. Our deal flow from having Walter Burdick on the board of Property Tax Consultants, the guy that was 38 years at IBM, I don't know how many deals he brought in the door, but I know there was a jillion of them. And all these guys on the dream team, they're class acts because that's what you want. They'll say, I only want to be there if I can make a contribution. Whereas you greedy bastards would be there whether you wanted to make a contribution or not. But the kind of class acts that you're attracting are guys and gals, a few gals, mostly guys, that are professionals. They know what it takes to make money. They've been there, they've done that. And they will want to make a contribution. And these Dream Team members will always make more contribution than you're paying them for the 1 or 2% equity. They always will. Now, another deal flow. Your lawyers and accountants. We have asked our lawyers and accountants. Arthur Andersen is probably the best at this in the country, the world, because they're computerized worldwide. All the offices are. We want to buy companies $5 to $50 million. These are the parameters. We're willing to pay 3 to 6 times earnings after tax. In this industry, the lawyers, same thing. The accountants, of course, Arthur Andersen is an accounting firm, and what I call the boutique ends of Arthur Andersen, or the big six, like Andersen Consulting. And Andersen Consulting is the only one that I know that has a separate deal like that. But virtually all the big six have a corporate finance type arm. And the best way to get a deal flow is to do a deal. Do a deal. And they will come out, you will be inundated. You will be run down. I still get as many deals crossing my desk or my staff's desk because they know I do deals. There are 2 or 3 or 4 people here that are principally here only because they want me to be involved in a deal. And then on top of them, I made the poor bastards pay to come and hear me scream at them for 12 hours. But the best way to get deal flow is to do a deal. I've told Lucinda, I don't know how many times, the first 3 or 4 or 5 or 6 are the most important. They're all important. But when people know that we are consolidating the industries, we'll have banks calling us. At the SDI deal that I did in Louisville a few days ago, I had 2 people No, I had more than two, but two that I remember, that one had 12 trailer parks and one had 30. Come up to me. And here. And I've passed them on to Lucinda, and she's following up. You will gain credibility with your lawyers, your accountants, your bankers when you do your first couple deals. Then they'll know you're for real, and they'll take the time to look for something that George is interested in or that Tyler's interested in. But your dream team, if you pick them right, should and will produce deal flow. Oh, this is the letter that Bruce describes, making the short phone call and getting people to respond to him so far 100% of the time. So we've already gone over that. No. This is highly confidential. We don't. That's why I made a slide of it. It's highly confidential correspondence between my partner and I. This is the same way that your lawyers are probably laughing about your documents that you sent them, you know. But it says, I was thinking about the reason we are batting 1,000% on getting companies that are not for sale to call back and wanted to pass along my thoughts. Their approach with the name from within the industry that they know. Ironically, that name was from the first acquisition we pursued but didn't consummate. A lot has come from that first contact. They are approached with a simple, low-key takeaway sale. We've been in the property tax business for some time and have done several Fortune 500 companies. We are looking to expand nationally and are looking for excellent regional and national companies to acquire. So-and-so, who I think you know, mentioned your company as being a top-notch organization. I don't know if you've given any thought to the acquisition of your company. If the thought has interest, you would obviously want to know who is on the other end of the phone, and I will send you biographies of our board of directors for your review. After your review, if you have interest, we'd like to meet with you in person, and if not, we appreciate the opportunity to have spoken with you, and am sure that our paths will cross professionally in the future. The first contact is quick. I work at it, keeping it brisk and being off the phone in 2 or 3 minutes. The key is to hit them with our strengths, lead them to reviewing the board, and get off the phone fast, leaving them a professional, no-nonsense message and first impression. I never get asked any questions about who we are, what we've done, etc. I am sure this is as a result of the track record, name recognition of our introduction and strength of the board of directors. While not all of your partners have all of these arrows in their quivers, they probably have other talents. No, I don't know, Bruce. Have other talents and accomplishments which will let them confidently approach their prospects with the same success. Oh, air conditioners here? Okay. This is not new and simply a confirmation of how well your approach works. The key, however, is the dream team and a quick professional introduction with a name they recognize. They all have called back. I always call first and follow it up with a letter with our board's biographies. I don't see any need to send the letter first since the initial phone contact is working 100% of the time. Obviously, you're making blanket offers like Lucinda is. I mean, you're just sending out dozens of them, and you don't have to do this. For almost everybody else that don't have the luxury of that, then this is a method that works. The other method that works is the actual sending out the letter. Okay. Other ways of deal flow. Direct mail, an acquisition profile, mailer with the SIC classifications and financial parameters would be sent to banks, law firms. Now, these are just blanket. I mean, you're blowing these out by the hundreds, the thousands. You're blowing these out. And yes, what's it cost to send a first-class letter today? Oh, it's going to cost you 32 cents every letter you send out. plus the envelope. Thank you very much. And low. So you might have, what, a buck, 50 cents to a buck in the... Huh? Yeah, well, you're not doing it. It's not your time. Armenians will do it themselves to save. The Scots will do it themselves. You know, they'll stay up to 4 in the morning so they didn't have to hire somebody else. Okay, so you're sending out letters. And then you follow up with telemarketing. Telemarketing means phone calls. Smile and dial. Not you, someone else. You have certified mail and telemarketing to target companies found through the Wall Street Journal, other business periodicals and research done in Bradstreet, $1 Million Directory. Advertise. Wall Street Journal, The Mart on Thursdays is best. You can put it on the internet. You have a web page. And what's not on here is you can get investment bankers to look for your deals for you. Now, they're not going to go look for $300,000 companies. But then the other side of it is you don't want a $300,000 company. Mike.
Perhaps I'm the only one. What's the $1 Million Directory?
$1 Million Directory is a directory that talks about companies that do $1 million or more in revenue, and they have various $1 million directories for various industries. Could you pass the mic up here, please?
Whenever you quote a figure with regard to a company, you're talking revenue. Is that correct?
Yeah. Now,
Okay.
when I talk to like this example, I'm talking revenue. When I talk about a $400 million company, it's what I sold it for, what the public market capitalization was, and most of you, when you talk about a $10 million company, it's because you did $10 million in revenue. When I talk specifically, when I say I built a $3 million company, a $50 million company, and a $425 million company, which were the first 3 companies I built, I was talking about what we sold them for, what they were worth on a public stock exchange market. I'm not talking about revenue, because revenue doesn't translate to anything. How do you put the revenue of a company in your pocket? If anybody's figured out that way, please tell me. This will be a good thing, as I tell Lucinda all the time.
Thing for transactions.
Correct. Revenue is a rule of thumb thing for transactions. Okay. Do we understand? Yes, Tyler.
But you do say that the most important thing for taking something public is just working the revenues. You don't care so much about the profits. You want to just pump the revenues up as high as possible. Is that correct? Or
you want to pump the revenues up, and then you want to clean up your act and make it profitable, because your value that when you take it public is going to be based on your after-tax earnings. I don't mind. You buy revenue, and then you bring in somebody else, not you, to make it profitable. I used to think I was the guy that could make companies profitable, and I used to waste my time doing that. Now I can bring in professional managers to make them profitable. I don't need to waste my time. I'm better at buying companies than I am making them profitable, because making them profitable is really a micro function. It's a management function, and I already proved to myself 20 years ago I'm not worth a damn at that. Larry.
Having the revenues allows you to borrow or get the finance, and then once and then the profitability allows you to cash in, basically.
Correct. Rick, did you have a question? No, you were just yawning? Oh, okay. Do we understand deal flow? Because not all of you are going to be in industries that have 10, 20, 30, 40,000 prospects. Lucinda's back there with a shit-eating grin on her face. Huh? No? In the mic. Oh, okay. So you've got to create the deal flow. And now, the only thing that this chart is missing is your investment banking firms, your merchant bankers in Europe, that also have a portfolio of companies and that can assist you.